Okay, today I'm going to give a presentation on our first chapter, which is the introduction to money and the financial system. First, I'm going to go over the definitions, content, and the material. However, I know that you can reach the details from the textbook, so repeating what the textbook says might be a waste of time. So in my presentation, my goal is to get to the core and to make sure you have a better understanding of the material. In order to implement this, first I'm going to include some charts to give examples of what I'm talking about. Second, I will design some questions and I'm going to talk about the answers of these questions. Now let me give a brief summary on what I'm going to do on this presentation. We have 3 learning objectives. First, I'm going to introduce the Federal Reserve economic data. We'll not have time to explore the Federal Reserve economic data, but I'm going to talk a bit about how to reach to this economic data, how to extract information from this data, as well as how to produce time series charts by using this data set. As well, let me say this. On Canvas, I created a module with a title Unit 1. On this module, you should be able to see an Excel file with the due dates, and also you should be able to see a PowerPoint presentation concerning the first chapter, but also you should be able to see a Word file that captures the details of how to extract information from Federal Reserve economic data. I suggest you to go use this Word file and go to the website and try to make yourself familiar with this data set. Second, I'm going to go over 6 parts of the financial system, and I want to make sure I will go through each part at a time. Similarly, I will identify the 5 core principles of money and banking, and again, I'm going to go over each principle at a time. First of all, it's quite easy to reach Federal Reserve economic data. Please click fred.stlouisfed.org that I show it on the top of the slide. Then you should be able to see a web page that looks like the one on this slide. This is a rich economic data set capturing both US and international time series. The good thing is that you can also upload the application on your smartphone. Here is what you will do. First, determine the economic indicator you're looking for. Then search this indicator. The search will produce a list of results, and then you click the one that's closest to your category, your search, and then a time series appear on a chart. You can add more time series on the chart by editing your time series. Once you're done, you can extract information on Excel file, or you can copy the chart on your laptop or your computer. There are 6 parts of financial system, and I will start with money. Before defining what money is, which could be very confusing, there's a common misconception that only paper currency serves as money. Well, money is a general concept. It's a broader concept, including a set of financial instruments like paper currency. Therefore, I need to be a little bit more precise when it comes to define what money is. If an asset is money, then it needs to have at least 2 properties at the same time. First, it should serve as a medium of exchange, and let me clarify what I mean by that. When an asset serves as a medium of exchange, then it should be useful to exchange it for goods and services. Second, it should serve as a store of value. Similarly, when an asset serves as a store of value, it should have purchasing power in the future. Let me give an example on that. A paper currency in the hyperinflation economy is less of money because currency outstanding or the value of currency, the real value of currency held by the public is decreasing over time. I'd also like to mention the third function of money. This is not the most important, but nevertheless, it's still important to mention. When an asset functions as a unit of account, it's a unit of measure for all the other assets. So when we talk about the distance, our measurements are inches, miles, kilometers, meters, centimeters, so on and so forth. So the same logic applies to the financial system. So when we like to calculate the value of a financial asset in a financial system, we depend on the unit of account property of money. Okay, what are the standard examples of money? There are paper currency, electronic funds, credit cards, checks, and money orders. But there are also non-standard examples of money. For example, the liabilities of the Federal Reserve Bank are called as outside money. One of them is a bank reserve or a central bank deposit. Note that a reserve is a loan to the Fed from a commercial bank. The similar idea with a checking account. A checking account is a loan to the commercial bank from us, from individuals, from households. Same logic applies there. And why I want to mention this outside money is because the non-standard money seems to become more important after the financial crisis than the standard paper currency. After the 1929 financial crisis, the Fed's response to that financial crisis, also known as the Great Depression, is to print paper currency. But after this financial crisis, we have seen an increase in the non-standard money. So let me clarify this by showing you this chart on the slide. On this chart, the horizontal axis shows the timeline starting from the financial crisis to today, and the vertical axis shows the numbers in millions of dollars. So there are 3 time series on this chart, and the first one, the blue line, represents the paper currency held by the public. As you can see, the paper currency is increasing steadily, and it seems like the financial crisis has no impact on the on the currency outstanding. The second line, the red or orange line, represents the bank reserves or the central bank deposits of depository institutions or commercial banks, if you will. As you might see, there's a sudden increase, there's a jump after the financial crisis. And this jump is from $10 billion to $2.8 trillion worth of bank reserves. And there's the third line, the green line, is the treasury balance. And let me say this, these are the liabilities of the Fed, or these are the obligations of Fed. The first obligation is, which is the paper currency, is whoever holds the currency, whoever holds the dollar. The second one is a loan, is an obligation to the commercial banks. And the third one, which is the treasury balance, is an obligation to the Treasury Department of the US government. Okay, on this slide, I'm going to talk about 3 other parts of financial system: financial instruments, financial markets, and financial institutions. A financial instrument is a legal agreement of one financial agent to transfer an asset to another agent at particular date with particular rules. And the financial instrument emerges as a useful tool for 2 reasons. First, is to transfer resources from savers to investors or lenders to borrowers. Second, to transfer the risk from risky individuals, companies, institutions to those who are safer. Well, what are the financial instruments for storing a value? They are debit accounts, checks, money orders, bonds, and bank reserves. How about the financial instruments for transferring the risk? A car insurance, a health insurance. And another interesting example that I think of, after the financial crisis, the Fed has adopted so-called a quantitative easing program. Basically, it purchased the toxic mortgage-backed securities from the financial system. I'm not going to go over the details of what mortgage-backed security is, what quantitative easing program is, but basically what happened there is a risk transformation from a risky homeowners to the riskless central bank. A financial market is a subset of financial system that permits people to buy and sell instruments quickly and efficiently. New York Stock Exchange is one example. Another example would be Federal Funds Market or Fed Funds Market, which is basically interbank loan markets among American commercial banks. When, for example, US Bank or PNC Bank wants to borrow from Bank of America, it goes to the federal funds market. And also a financial institution provides an access to the financial markets. Well, we can consider any institution as an example, like commercial banks, money market mutual funds, investment banks, central bank, and all those things, all those companies, firms, all those are the examples for a financial institution. The last two parts are government regulatory agencies and the central banks. For example, the US government introduced regulatory agencies like Federal Deposit Insurance Corporation, US Securities and Exchange Commission, Office of the Controller of Currency, so on and so forth. In order to enforce first the rules for financial institutions have to operate in the financial markets. Second, to provide oversight and supervision through examination and enforcements. The two most important regulatory changes were Dodd-Frank Act and Basel III Accord. Well, I'm not going to go through the details of these changes, but one of the most important change is that the Fed started to regulate the investment banks. Remember, Lehman Brothers, one of the investment banks, collapsed during the financial crisis. This happened because they took too much risk and there were no regulations on the investment banks. And there are a lot of other details, but I'm not going to go over. I just want to give a quick remark. I just wanted to give a quick remark on what the regulations are. For example, the Federal Deposit Insurance Corporation enforces the commercial banks to pay a fee proportional to their asset holdings. And the core of financial system is, of course, the central bank. And what does the central bank do? Central bank controls the availability of money supply by adjusting the key interest rates, controls the stability of financial system, and promotes high economic growth. Let me go over the 5 core principles of money and banking. I will start with the first principle. Time has value. And let me prove this by using a chart, as you can see on this slide. Well, I put 4 time series by using Federal Reserve economic data. 4 time series of treasury bills. What's a treasury bill? A treasury bill is a loan issued by the Treasury Department. Well, remember, Treasury Department is the fiscal authority of the US government, while the Federal Reserve Bank is the monetary authority of the US government. They are 2 different things. Okay, so I put 4 different treasury bills in the same chart. They're different with respect to their maturity times. While the vertical axis shows the percentages, while the horizontal axis shows the timeline starting before the financial crisis to today. The blue line represents the 1-year treasury bill, the red line represents the 6-month treasury bill, the green line represents the 3-month treasury bill, and the purple line, I guess, represents the 4-week or 1-month treasury bill. As you can see, the green line 3-month treasury bill is above the interest rate on 3-month treasury bill is higher than the 4-week the interest rate on 4-week treasury bill. As well, the red line is above the green line. It means the interest rate on 6-month treasury bill is higher than the interest rate on 3-month treasury bill. As well, the blue line is above the red line, which means the interest rate on 1-year treasury bill is higher than the interest rate on 6-month treasury bill. What does this mean? This means that the later a loan matures, the larger the interest payment is. This clearly proves or satisfies with the first principle. Okay, the second principle is the risk requires compensation, and I'm going to give an example again to support this principle. I extract this chart from Federal Reserve economic data, as I did the last one. The vertical axis shows the percentages, while the horizontal axis shows the timeline. The blue line represents the interest rate on a corporate bond, while the red line shows the interest rate on the treasury bill. Remember, a corporate bond is a loan issued by a corporate, by a company, or by an investment bank, or by any financial institution to fulfill the liquidity needs. However, the treasury bill is issued by the Treasury Department of US government. As you can see on this graph, the interest rate on the corporate bond, even though it's the highest quality, is larger than the interest rate on the treasury bill. This is because the Treasury Department is a safer institution than the corporates. That being said, let me discuss a question or a puzzle, if you will. So, if time has value, why are the financial institutions often willing to extend individuals a 30-year mortgage at a lower annual interest rate than they would charge for a 1-year loan? According to first principle, a 30-year mortgage needs to charge at a higher annual interest rate than a 1-year loan. How do we explain this? So we explain this with the second principle. And the idea in here is that the mortgage comes with a collateral. So if you want to take out a mortgage loan, you have to put your house as a collateral. And the collateral implies a guarantee. It means less risk. It means a less risky asset. Therefore, by collateral, by the second principle, we can explain this puzzle. So the third principle is information is basis for the decision. Let me give an example from the recent financial crisis on this principle. We know that during the financial crisis, the depositors of the investment banks who hold large chunk of monies in the investment banks, these deposits were securitized in a way that the mortgage loans are backed, the mortgage-backed securities are used as collateral to support those deposits. And apparently, the lenders, the depositors who put their money in their investment banks fail to assess the creditworthiness of the mortgage-backed securities. It turns out that the collateral that has been used to support their deposits are not as good as they think they are. And the financial markets, then the panic arises, the depositors start withdrawing their money, and the financial market collapse. And let me discuss another question, a relevant question. Why are large publicly listed companies more likely to meet their financing needs by selling financial instruments such as bonds to the market, while small businesses get their financing from financial institutions such as banks? Well, this is because it's less costlier for a commercial bank to get an information from a small business, thanks to their strong network. So a commercial bank spends less money to get an information about the creditworthiness of a small business. But this doesn't apply to the large companies. So it's easier for a large company to meet its financing needs by selling corporate bonds. The fourth principle, the markets determine prices and allocate resources. This is strongly related to principle 3. It's actually a result of principle 3. Information is basis for decisions. To be able to make a decision in a trade, in a transaction, we have to have information about who we are lending to, who we are borrowing from, or information like how much we are willing to pay. And the financial markets are collecting those set of informations. And given that you can get to have an information in a financial market how much you're willing to pay for an asset, we can say that the markets determine prices. And the markets also allocate resources to the extent that it transfers the resources from the riskier financial agent to the safer financial agent. We know that the government is heavily involved in the financial system. Why is that? Because for the financial market to work efficiently, there has to be regulations, there has to be rules, and there has to be a supervision. Financial markets might be very fragile. Like, think about what happened in the recent financial crisis. The mortgage-backed security market collapsed. It turns out that those securities are not as good as strong as trustable as it was perceived once upon a time. And the principle number 5, the stability improves welfare. This is related to the second principle, risk as a compensation. Well, any effort for eliminating the risks on a macro and macro level are key for promoting the welfare. So if there's a business cycle, which means if we have a financial crisis, the central bank is going to decrease the key interest rates to make sure people start invest their money on outside rather than putting their money in the bank. If the economy is growing too fast, then the central bank is going to increase the interest rate on excess reserve. This is called the business cycle. So against the business cycle, the monetary policy will be adjusted so that it will promote the stability and so that it will improve the welfare. And on micro level, if you have a health issue, for example, you're going to get a health insurance. So getting rid of any risk or trying to eliminate the risk is key for stability, and this promotes the welfare.